In this video, I want to talk to you about IPO. So what exactly is IPO? Speaking of IPO, we may think of the pictures of major companies rushing to ring the bell at NASDAQ, which we often see on the internet. What kind of magic does this place have that can attract so many companies around the world to come here just to ring their bells? First of all, we must know that IPO is the abbreviation of Initial Public Offering. IPO refers to the first sale of shares by a company to public investors. So how to sell shares to investors? After listing on the stock exchange, stocks can be publicly traded and investors can buy stocks. Ringing the bell at NASDAQ is a symbolic ceremony for companies to complete their IPOs and officially list for trading. Speaking of this, we have to mention the two largest stock exchanges in the world, NASDAQ and New York Stock Exchange. NASDAQ is the world's first fully electronic exchange. It abandons the traditional trading hall and relies on technology to make stock trading more efficient and transparent. NASDAQ is known for supporting growth and innovative companies. Many technology giants such as Apple, Amazon, Microsoft, and Google have chosen to list on NASDAQ. It can be said that it has witnessed the rise of the global technology wave. The heart of Wall Street is the New York Stock Exchange, founded in 1792. As the oldest and most well-known exchange in the world, the building of the New York Stock Exchange itself carries a heavy sense of history and tradition. The New York Stock Exchange mainly accepts large-cap, mature companies and is considered a barometer of global economic stability. Many world-class companies, such as Coca-Cola, IBM, and ExxonMobil, are listed here. The New York Stock Exchange is not only the cornerstone of the U.S. financial system, but also an important hub for global capital flows. It symbolizes a stable, mature, and reliable investment environment. After saying this, I think everyone should have a preliminary impression and understanding of IPO. So let's talk about why companies need IPO. One of the reasons is financing. If a company wants to operate, it is inseparable from money. The company needs sufficient funds to operate. So where does this money come from? The first is to earn it yourself. The income obtained by the company through the sale of products or services is also the main source of funds. The second is to borrow money from the bank. The company borrows money from the bank to meet the capital demand, but it needs to repay the principal and interest on time. The third is the financing we have been talking about today. In simple terms, it is to ask someone for money. There are many ways to ask someone for money. One of the best ways is to tell others that you are a listed company, and the most important step to go public is IPO. The above is the most important purpose of IPO, which is to raise funds for the company. So what else does IPO do? It can also optimize the capital structure of the enterprise. We all know that sometimes in order to operate better, enterprises may borrow more money from others. What effect will it have if they borrow too much? The enterprise will have debts. Most of the enterprises nowadays are often accompanied by a large amount of debts. So what should we do with the money we owe? IPO can help us reduce the company's dependence on debt financing by introducing external equity investment, thereby reducing financial risks. After saying so much, everyone may be a little confused. Let's use a more intuitive example to illustrate the issue of financing. I now run a new energy vehicle company called Besla. Our Besla is now preparing to go public. Before the listing, our mall is 100% controlled by me. Now suppose our company is worth $10 billion and the company's cash flow is $500 million. Now we want to dilute 50% of the shares and issue 100 million new shares at $100 per share. Now Peter, Fred, and John all want to buy our Besla shares. In this way, our 100 million new shares will allow us to raise another $10 billion. At this time, the value of our company becomes $20 billion, and the equity held by me becomes 50%, and the money in the company's account becomes $10.5 billion. In addition to the financing we mentioned above, another benefit of an IPO company is cash out. Before the company goes public, the founders and early investors want to exit, that is, sell their shares. At this time, we need to find someone to take over to cash out. In fact, we can also sell our shares before going public, but it is difficult to find someone willing to buy my shares at a reasonable price before going public, because investors don't know our company at all, so how can they be willing to invest? I may offer a 50% discount and no one is willing to buy, but after the company goes public, it is completely different. The information is more transparent and investors are more willing to take over. The returns on the shares we sell are higher, which means it is easier to cash out. We can also talk a little bit about cash out. Let me give you an example. Formula One is also called F1. As a famous sports event in the world, I believe everyone has heard of it. In the early days of F1, as a racing sport, there was not much commercialization until the emergence of Bernie Ecclestone. In the 1970s, Bernie Ecclestone acquired the Brabham team and gradually took control of the commercial operation rights of F1. He cooperated with the team and signed the Concord Agreement, which ensured the team's share of the event income and established FOM to manage the commercial operation of F1. We will not focus on this story, but on the story of the European private equity fund CVC after Bernie Ecclestone. After Bernie, CVC acquired most of the shares of F1 through leveraged acquisitions. CVC used $965 million of its own funds and $1.1 billion of loans borrowed from RBS Royal Bank of Scotland to complete the acquisition of F1. As a private equity fund, CVC acquired F1 for the purpose of making money. During the period when he controlled F1, he attached great importance to the short-term benefits of F1 and did not consider the long-term development of F1 at all. He frantically squeezed the profitability of F1 and finally sold its F1 shares to Liberty Media Group in 2016 at an enterprise value of $8 billion. Through this transaction, CVC and its investors made a total profit of about $5 billion during the period of holding F1. The process of selling F1 shares is what we call cash out. In addition to financing and cash out, IPO can also increase the company's visibility, enhance the company's brand influence and market recognition, and improve its market position. The company's exposure in the capital market can attract more customers, partners, and outstanding talents. IPO is undoubtedly a free advertisement for the company. Investors are more willing to invest in listed companies rather than those that are not listed. IPO has so many benefits. Why don't all companies choose to do IPO? Because the IPO process is also very troublesome. First of all, your company must have a certain scale and stable profitability so that you can meet the listing requirements of the securities market. After you meet the requirements and determine the goal of IPO, you have to hire professional institutions. You need to hire investment banks, that is, underwriters, to be responsible for issuing, pricing, and selling stocks. You need to find accounting firms to help you audit financial statements to ensure compliance with regulatory requirements. Of course, you also need to hire law firms to deal with legal compliance issues. Finally, you also need to hire consulting companies to provide strategic guidance, corporate valuation, market positioning, and other services. After doing this, your IPO preparation stage is ready. After completing the preparations, you will need to reorganize and prepare your company for compliance. First, you need to optimize the corporate governance structure according to regulatory requirements, such as establishing a board of directors and independent directors to adjust the company structure. Then you need to deal with legal and financial compliance issues. The company needs to clear debts, consolidate financial statements, ensure financial transparency, ensure the legality of the business, and deal with potential legal disputes. After doing all this, write a prospectus, which needs to include corporate information, fundraising plans and uses, and investment risk disclosure. Then you can enter the application and approval stage, at which time you can submit an application for listing and accept review. During this period, you need to show potential investors the investment value of the company, conduct some online publicity, hold several press conferences, and conduct some reports. This is what we call a roadshow. After the roadshow, you can finally price and issue it. Let's stop here for IPO. In fact, in addition to IPO, there are many other ways to go public, such as reverse takeover, which can directly obtain listing status by merging with an already listed company, or direct listing, where the company directly lists existing shares on the stock exchange without issuing new shares or going through underwriters. There is also SPAC, which is listed by merging with a special purpose acquisition company, where SPAC is a shell company established for the purpose of merger. However, the financing scale, market recognition, and brand effect of IPO are often unmatched by other listing methods. I hope that everyone who is watching the video now will be able to ring the listing bell on the New York Stock Exchange or NASDAQ one day. That's it for the introduction of IPO. Thank you for watching.